All right, let's dive in. Today, we're pulling back the curtain on the world of Forex trading. Ever feel like it's some kind of secret club just for Wall Street wizards? Well, this explainer is for you. We are going to break it all down to the absolute basics. So, let me start with a question for you. Picture this. You're at the airport, super excited for a vacation. Have you ever walked up to one of those currency exchange booths to swap your dollars for, say, euros or yen?
If you've done that, then guess what? You've already taken part in the world's biggest financial market. It's true. That simple transaction you made is just one tiny, tiny drop in a colossal ocean of money that's constantly flowing around the globe every single second of the day.
So, to really get a handle on what that colossal ocean actually is, we first need to talk about the incredible scale and the structure of the Forex market itself.
So what is Forex, really? Well, when you boil it all down, it's the global marketplace where all the world's currencies are traded against each other. And the whole game, the entire goal, is to make a profit by predicting if one currency is going to get stronger or weaker compared to another. It's just like what you did at the airport, but on a massive, speculative scale.
And when I say massive, I am not kidding. Get ready for this number. The amount of money traded every single day in the Forex market is around $7.5 trillion. Yeah, you heard me right. Trillion with a T. It completely dwarfs any stock market on the planet. It's not even close. Now, here's what's so fascinating. Where do people like you and me, the so-called retail traders, fit into all this? Well, you can see the real heavyweights are the huge central banks and financial institutions. We as individuals make up that tiny little sliver of the pie, somewhere around 3 to 5% of the total. It's so important to remember you're a small fish in a very, very big pond.
And unlike the stock market that has its opening and closing bells, the Forex market literally never sleeps. It's a global, decentralized network that just keeps on running 24 hours a day, 5 days a week. It basically follows the sun around the globe as the major financial centers open for business, starting in New Zealand, moving to Asia, then Europe, and finally to North America. And then the whole cycle just starts all over again.
Okay, so we know what the market is, but what are you actually buying and selling here? It's not a piece of a company or a barrel of oil. So let's talk about the product itself.
This right here, this is the core idea you really need to get. When you buy a currency, let's say you buy the US dollar, you're basically buying a share in the American economy. You're making a bet that the US economy is strong and is going to do well, which should make its currency more valuable. Your profit or your loss all comes down to whether that bet was a good one.
And these are the big 8, the heavy hitters of the currency world from the largest economies. And traders have given them some pretty fun nicknames over the years. You'll hear people talking about the loonie for the Canadian dollar or the cable for the British pound. It definitely adds a little color to the whole thing. Now, you never just trade one currency by itself. It's always a dance between two and what's called a pair. The most common ones are the major pairs, and they always include the US dollar. Because a ton of people are trading them all the time, they have really high liquidity, meaning it's super easy to get in and out of trades, which keeps your trading costs low. Honestly, these are perfect for beginners. Then you have the exotic pairs. They're way more unpredictable, way riskier, and it's best to just steer clear until you've got a ton of experience under your belt. Okay, so we've covered the what, so now let's get into the how. This section is all about breaking down what a trade actually looks like, from reading the quote to hopefully making a profit. Okay, don't let this look intimidating. It's actually super simple once you get it. Every trade starts with a quote, like this. EUR/USD equals 1.1800. The first currency, the euro, is called the base currency. Just think of it as always being equal to 1. The second one, the US dollar, is the quote currency. And the number simply tells you how many US dollars it takes to buy that 1 euro. So in this case, 1 euro costs 1.18 US dollars. That's it. But there's always a small catch, right? You'll actually see 2 prices, not one. A price to buy and a price to sell. The tiny little difference between those 2 numbers is called the spread. And that spread, my friends, is how your broker makes their money on every trade you place. Think of it like their commission. So, how do you make money? It all comes down to one thing, predicting which way the price is going to go. If you think the euro is about to get stronger, you go long. You buy the pair, planning to sell it later for a higher price. But, and this is cool, if you think the euro is going to get weaker, you can go short. You sell the pair now, planning to buy it back later at a cheaper price and pocketing the difference. Okay, now we're getting to what is, without a doubt, the most exciting and also the most dangerous part of trading Forex as an individual. Let's talk about the powerful tools you can use and the very real risks that come right along with them. The most powerful, game-changing tool you have in your arsenal is something called leverage. But what on earth is it? Let's say you open a trading account and you put in $2,000. In most markets, that's what you've got to work with, $2,000. But this is where Forex gets wild. Brokers offer you leverage. So with a pretty common 50-to-1 leverage, your $2,000 deposit, that's called your margin, suddenly lets you control a position in the market worth $100,000. It sounds amazing, but this is exactly where the danger comes in. And this is why. You have to understand that leverage is a powerful double-edged sword. A tiny price move in your favor could make you a $500 profit. That's a huge 25% return on your account. But, and you absolutely cannot forget this part, that exact same tiny price move against you means a $500 loss. You've just wiped out a quarter of your account in the blink of an eye. Leverage amplifies your wins and your losses equally. Okay, for our last piece of the puzzle, let's learn a key bit of the lingo. I keep saying small price moves, but traders have a specific name for that, so let's talk about pips. A pip actually stands for percentage in point, but all you really need to know is that it's the tiniest standard unit of price change. For most currency pairs, like our euro versus the US dollar example, a pip is just a change in that fourth number after the decimal point. It's a fraction of a penny. Let's see this in action. Take a look at this price for the euro versus the dollar. It's 1.1050. Now keep your eye on that very last number, that 0. And there it is. The price just ticked up to 1.1051. That tiny little jump? That was a 1 pip move. And all those profits and losses we were just talking about, they're all calculated based on how many of these little pips the price moves while your trade is open. So there you have it, the absolute basics. We've covered what the Forex market is, how a trade works, the risks of leverage, and the language of pips. It's a market that's moved by literally everything, from a country's interest rates to political drama, which leaves us with one final thought. Since this massive global market is like a real-time report card for the world's economies, what are all those tiny constant movements really trying to tell us about our shared economic future?